Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Good day to you and welcome to this CPD learning activity hosted by SA Accounting Academy and presented by Anton van Wyk. For some more background information about myself, you're welcome to have a read on this slide. And then today's webinar, obviously we're dealing with section 26 on share-based payment and section 28 on employee benefits in the IFRS for SMEs. So the agenda points that I wish to cover, firstly would be section 26, to have a look at the scope of section 26 and some information about vesting conditions, then deal with equity settled share-based payment transactions, and then cash settled share-based payment transactions, and then what we do when there are alternatives. And then we'll also just have a look at the disclosure in the notes to the financial statements. Once we've covered section 26, we'll move over into section 28 and cover short-term employee benefits, post-employment benefits, long-term employee benefits that are not part of your post-employment benefits, so other long-term employee benefits, and then also termination benefits. All right, so we have quite a lot to cover in this 2-hour webinar, so we better make a start. All right, so if we start off with section 26, the scope of section 26 is that all share-based payment transactions are governed in terms of section 26, as long as we can determine and prove that it is a share-based payment transaction. So the share-based payment transactions that are covered are normally equity settled share-based payment transactions. And what that means is that the entity acquires goods or services. And while we're busy with that, I just want you to make a note that the acquisition of goods or services must always be one of the characteristics that we test for in order to identify a share-based payment transaction. So the entity acquires goods or services as consideration for equity instruments that the entity issues, including its own shares, share options, share appreciation rights. Those are your typical equity instruments that are issued in return for goods or services. Now remember, these goods or services can be received from employees, especially services, and also suppliers, being goods or services. So the point that we're making here is that they are equity settled. So in return, we'll be issuing an equity instrument of the entity. The second main group of share-based payment transactions will be your cash settled share-based payments. And that is where the entity also acquires goods or services by incurring liabilities. So this means that the credit side is not equity. The credit side is a liability. So compare that now to equity settled. So the credit side being equity in that case, so reserves being created until share capital can be issued. And then with cash settled share-based payment transactions, obviously the credit side being a liability. Now we see here goods or services are acquired, and then the entity incurs in return a liability to the supplier of the goods or services for amounts that are based on the price or value of the entity's shares or any other equity instruments of the entity. So what is interesting here, that is obviously the link to share-based payment, is that on the debit side, yes, we're obtaining goods or services, so we can click that box. But on the credit side, this time we are not issuing any of our own equity instruments. We're not issuing options or share appreciation rights or anything like that. We are going to obviously, basically value the liability with reference to movements in the value of our own ordinary shares. Now, obviously, share appreciation rights are included under cash settled share-based payments because you're not obtaining actual shares. You're obtaining a right of settlement, which is based on the movement in the value of the shares of the entity. So that is why share appreciation rights are included in your cash settled share-based payment transactions. All right, so I think this gives you a good idea as to what it is that we'll be dealing with in section 26. In both cases, the debit will belong probably in employee benefits, all right, depending on whether we are obtaining, when we are obtaining share-based payment transactions and goods and services from employees here, or the debit could then also be another asset or another expense, depending on the type of service or goods that we obtain from other suppliers. All right, so that will obviously be our consideration here for the debit side of the transaction. And then the credit is we need to make sure that we understand how to account when we are going to settle, based on an equity basis, or settle based in cash with a link to the underlying equity instruments of the issuing entity. Now, transactions in which an entity receives or acquires goods or services, and the arrangement provides either the entity or the supplier of the goods or services with a choice of whether the entity settles the transaction in cash or by issuing equity instruments, will also fall within the scope of section 26. All right, so we'll have a look at the accounting for all of these types of transactions. The recognition principle is relatively simple, as we said. Goods or services received in the transaction are recognized when the goods are obtained or the services are received. So it's always a good idea to think about your revenue recognition principles when control has been obtained, for example, over the goods, when the benefit of the services is being received, how that is received. Is it gradually over time, or is it all at once? And when that point happens, that's when the recognition of the share-based payment transaction will occur. Secondly, then the entity shall recognize a corresponding increase in either equity if the goods or services are in an equity settled transaction, or liabilities if the goods or services were received in a cash settled share-based payment transaction. And then just the last consideration there, when the goods or services received or acquired in the transaction do not qualify for recognition as assets, the entity must recognize them as expenses. For example, our typical one when we receive services from our employees. So the reason I'm pointing this out is that we might have to think of our concepts of assets versus expenses on the debit side. And it's not always so clear-cut as employee benefits, because your employees are not always involved in the share-based payment transaction. So it's very important to establish what it is that you're actually receiving, not only when you receive it and when you obtain control or the benefit of the goods or services, the risks and rewards when they pass to you, but it's also important as to whether there will be future economic benefit attached to those goods or services that you're obtaining from the supplier, for example, in that case, and then whether those goods or services should be recognized as assets and not expenses. So the approach that we normally follow is that debits are assets until they have been conceptually disproven, and then they are automatically expenses. So we don't set out to prove expenses, we set out to disprove assets. And if we cannot disprove an asset, then obviously the debit will be an expense. So that's the approach that we follow in terms of the conceptual framework of international financial reporting standards, and also the IFRS for SMEs. Okay, so interesting types of transactions that we're encountering as part of share-based payment. All right, so before we move into the two types of share-based payment transactions, an aspect that can impact the accounting of the transaction will obviously be the concept of vesting. Now, when we grant, for example, equity instruments, we can grant, for example, an option to obtain some of our shares. We can grant our shares immediately. We can grant share appreciation rights. We can grant whatever it is, okay, that we want to use as an instrument. Now, we need to ask ourselves, is there vesting involved? Now, vesting means The moment that you become entitled to this particular right that you have been given, that is when that instrument has vested with you, who is the holder of the instrument.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.